Well, welcome back. Now we'll look at where markets ended the week with the big banks posting mixed results to kick off the fourth quarter earnings season. We've got a lot more coming this week. We also got new reads on inflation holding steady for both wholesale and consumer inflation. And the 30-year fixed rate mortgage is now at the lowest level in over 3 years, stuck at just over 6% on the 30-year. Joining me now is the Lonski Group founder and president, John Lonski. John, good to see you. Thank you so much for being here. And here we are in the middle of earnings season. That will likely set the tone for markets. But you're looking ahead to the impact of the tax cuts and the tax refund season. What are you expecting?
There's a lot of money that's going to be poured into the U.S. economy by tax refunds and tax cuts in 2026, and that can only be a positive for economic growth. You know, and thus far, this expectation of this fiscal jolt, this influx of money from tax cuts and refunds hasn't put all that much upward pressure on bond yields, and that's a good thing. And it very well might be the case that if the refunds and the tax cuts do enough to stimulate spending, we might well see a meaningful recovery by jobs growth come the second quarter of this year.
Well, this morning, I was looking at a number of expectations, and I see that Piper Sandler is looking at some $200 billion in tax refunds, and the analyst there says they're going to spend 70% of that. So if we're talking about, I mean, Kevin Hassett, for example, told me on Friday that we're watching the biggest tax refund season that we've ever seen.
Our expectation is that you're going to have the biggest refund season ever, which is going to be a significant positive stimulus for the economy. But I will add a non-inflationary stimulus because we've got all the supply going up, too. We've got $18 trillion in new factory construction and so on. And so I think that it's really, you know, the Trump golden age is going to be tested, the theory of it this year. And I think it's looking pretty good.
And he said that that money is going to be spent. What are you thinking about the tax refund season and its impact?
I think he's right. He's correct. 70% of that $200 billion might be spent. That's about $140 billion. That can only be a positive for growth. If the economy begins to grow and inflation doesn't rise significantly, then who cares about Fed rate cuts? Do we really need Fed rate cuts if the economy is growing at a 3% pace, while at the same time we have payrolls again growing by maybe at least 150,000 jobs per month? And that could be very important from a political perspective come the November midterm elections.
Yeah. By the way, Kevin Hassett also told me that next week, when the president is in Davos, Switzerland, for the World Economic Forum, he's going to announce a new opportunity for people to tap into their 401k plans and take money out, use that money as a down payment for buying a home. So he's trying. Yes, go ahead.
You're hitting on a very important point. You're talking about the equity market, the gains of the past week. For the year to date, many people don't realize this, but the outlook for home sales has improved substantially, partly because of these expected changes in policy as it affects housing. It's hard to believe that the S&P 500 stock price index for home builders was recently up by more than 12% for the year to date. That's incredible. And this has also benefited home improvement retailers like Home Depot and Lowe's. Their stock prices are up by between 10 and 12% for the year to date.
Yeah, great point. Meanwhile, on earnings, the big banks posted nearly $600 billion in revenue last year. President Trump wants credit card companies to limit interest rates to 10% for the next year. Credit card rates currently hover around 20%. The banks are upset. I don't know if this is going to be long-standing because the president needs Congress to codify it. But what's your take on the president's proposed cap on credit card rates? Big impact?
Yeah, you're correct that such a change in the law requires congressional approval. Well, the problem here is, if you put, for instance, a ceiling on rents, what do you end up with? Less rental housing. If you put a ceiling on credit card rates, you're going to have less credit card debt available for consumers. And the consumers that are going to be hurt by this would be those consumers of lesser credit quality, especially especially younger consumers. Banks will become far more selective as far as who has access to credit cards. And if younger consumers, consumers of less credit quality, can't borrow through credit cards, that would also mean less in terms of consumer spending. Less consumer spending at a minimum is not good news for retailers. I don't think this suggestion is going to make it.
Well, I'll tell you, I mean, one analyst, I was reading his report, and he's expecting that this is going to impact earnings in a big way. He says that it's going to impact bank earnings and certainly the credit card company earnings by between 5 and 18%, wiping out earnings there, John.
And you're right, Maria. You know, I think of late we have seen quite a decline in the share prices of credit card companies.
All right, we will leave it there. John, always a pleasure to see you. Thanks so much.
Same here, Maria.